Okay, guys, let's get going. Morning, everybody, and apologies for the slightly late start today. As always, family issues have to take priority. In any case, today's topic for us at GoPro Trading Academy, this is for our members only, is the practical issues around developing a probabilistic mindset for professional trading. So, we could talk about all the theoretical aspects of this, and we have to, and I'll explain why in a minute. But it must always come down to practical application, because as traders, we are practitioners. We're not, we don't live in an ivory tower. We are judged on our results. So the only purpose for developing a robust trader's mindset and this concept of a probabilistic mindset is to help us get actual financial results on the table that we can show to existing and prospective clients, and of course for our own benefit in terms of the reason why we're trading, to make as much money as possible for the least amount of risk as possible, and that's obviously always a key factor to add in there. All right, so what is this all about then? Let me just go back to a previous slide. I think it is. No, maybe it's the next one. Okay, let's start here. I always talk about, and I ask the question of people when they come on my courses, what do you think trading is actually all about? And we get the various answers. It's about making money, it's buying and selling, it's engaging with the markets, it's risk management, all of those good things. And they are all true in their own way, but at a deeper level, the only thing that trading is actually all about is dominating over an environment that's characterized by uncertainty. And if you've been on my courses before, then you've probably heard this many, many times, but it doesn't get stale, and it's as essential as ever to understand this properly. All right, so the first thing that we need to understand is this concept of anything can happen. That's the first of 5 fundamental principles put forward by Mark Douglas in his seminal book called Trading in the Zone. If you haven't read Trading in the Zone, by the way, then you're really setting yourself up for failure. I do not know any successful trader ever. I've never met one who has not read Trading in the Zone, and in fact read it multiple times. So it doesn't have everything in there, but it is an essential foundation for us. So getting back to what he says, the first of his 5 fundamental principles in trading that you have to embrace is that anything can happen. The second is that despite that being true, you don't need to know what is going to happen in order to be a profitable trader. Now, the first time you hear or read that, you'll sort of just nod your head sagely, and maybe it will bounce along the surface of the intellectual part of your mind. But I'd like you to think about those 2 principles much more carefully, because if you do, you will realize that they are apparently incompatible. It's like oil and water. They shouldn't be able to mix, or trying to get 2 magnets to touch with like poles. You can't, on the surface of things, in any case. Anything can happen, okay, which basically means that you can't predict the market. If anything can happen, it's basically the same thing. Or another way of putting it is that the market is effectively random. That's already now going to cause you a mental problem. But the second one is what is really intriguing. Combined with that, you don't need to know what is going to happen next in order to be profitable. And if you ponder on this for a minute, I'm sure you will start realizing that, hang on, this doesn't make sense. There's a paradox here, and seemingly an unresolvable paradox as well. And yet it's absolutely true. And answering that paradox, or resolving that paradox, is essential for you in your journey to becoming a successful trader. You really have to resolve that paradox. But I'm going to help you to do that today. That's a lot of what this discussion is all about. So first first of all, let's understand what we're actually engaging with. Again, let me reiterate that we are dealing with an environment that is characterized by fundamental uncertainty. That's what that first statement, anything can happen, is reflecting over there. And when dealing with an environment that is characterized by such fundamental uncertainty, we typically bring our traditional way of operating to the table. But as I've mentioned many times before, there's a problem with that. And the problem is that our brains are effectively predictive engines. This has been established scientifically. It's been established through decades of research. And that for us is a massive advantage in normal circumstances. And when I say normal, I'll get to that in a minute. But effectively, what we have been able to do as a species is dominate our environment by doing by doing two things. First of all, recognizing how to, or I beg your pardon, recognizing patterns that repeat themselves reliably, and based on that, building predictive systems. So the obvious one would be a watch. A watch is based on the clearly identifiable and reliably repeating cycle of the Earth's spinning round and round and round, and of course then spinning around or moving around the sun. You know, the sun coming up and the sun going down, and the seasons and so on and so forth. So we recognize that as a very reliable pattern. So there's the watch, there's the clock, but there's also agriculture in terms of being able to know when to plant and when to sow, when to reap, and all of that, and so on and so forth. But and that's one side of it. So our brains have been able to identify wherever they exist these reliable repeating patterns. The other thing that we've been able to do is to use our three primary strengths, if you like, to dominate the environment wherever possible. And I won't go into that in too much detail now. If you've read my book, you'll know more about this as well. But we're going to go into this in a lot more detail as well, by the way, in our masterclass coming up next month. But we have these three key abilities that certainly altogether no other species has, as far as we know. And the first, obviously, is rational ability, the ability to work out problems, to define problems and resolve them. The second is tactile ability, the ability to manipulate things with our fingers and having an opposing thumb, very, very important. And finally, the ability to communicate and therefore collaborate, not just with each other at the same time, but over time as well. So being able to record what we've learned so that people in the future don't have to reinvent the wheel, literally, and able to build our body of knowledge and therefore ability to invent new technologies and so on and so forth. So all of which is designed, however, to gain control over the environment. But why are we doing that? Well, likewise, so that we can safely predict outcomes. That's the whole purpose. And even if you dig a bit deeper and you go into modern concepts such as education, the reason why we want our children to have a good education is so that they have more control over their lives and determining or guaranteeing, if you like, as much as possible, a favorable outcome in their lives and avoiding bad outcomes, like living on the street. So that's all about having control over our environment with the aim of being able to predict good things and the avoidance of bad things. Or the ability to generate positive outcomes and avoid bad outcomes. That is how we operate. That is the human condition. There is nothing else. Everything else is just detail. But the problem now is this, and that's effectively what we are putting together in this little diagram, which I'm going to go onto in the next page here. We have this environment now in trading where, first of all, we cannot gain control of it. You know that. There is no way that you can actually manipulate the market so that it can move even a fraction of a pip in the direction that you want it to. There is just no way. It's not possible. So your cognitive faculties, your tactile abilities, and your ability to communicate and even collaborate doesn't help you at all when it comes to trying to get the market to do what you want it to do, to be able to avoid a negative or bad outcome and to generate a positive outcome. So that's the one side. That leaves us with the other side, finding reliable repeating patterns. And really, this is what people fall back on. And we even discussed it yesterday in terms of the combination of indicators to try and figure out something that's going to help you to do what? To predict what's going to happen next in the market so that you know when to get in and when to get out. That's the whole point behind all of that stuff. And even when it comes to the use of price action, as we were discussing, even that you will naturally want to harness those abilities so that you can only take trades that win. Tell me I'm wrong. Tell me that that is not what you are fighting to achieve all the time in your trading. Well, as long as you're doing that, you are doomed to fail as a trader. What we are effectively doing is you are pretending that it is not an environment that is completely uncertain. And even worse, what you're trying to do is to create some kind of crystal ball so that you can avoid negative outcomes called losing trades and generate positive outcomes called winning trades. Well, it just doesn't work. None of that is possible. Which leaves us with this question: how then do good traders engage with what's effectively the unknowable unknown, an environment that is non-predictable, in order to be profitable or to produce this capital growth? How is that done? Because we know that there are profitable traders out there, yours truly being one of them, and which is why I'm here to try and teach you the answer to this question. But the problem is, most people don't even get to understand that this is the right question. They never even get to ask this question. They don't even understand that this is the problem. But until you do understand this is the problem, you have no chance in learning how to trade. It's a waste of time. Unless you are prepared to embrace this problem fully, and therefore engage with all of your faculties to resolve it, you will not succeed as a trader. And this leads us to this thing called the probabilistic mindset, which is the right mindset. Now, let's first of all just talk about, before we get there, what it is not, okay? Just to reiterate everything we've been talking about. And I love this quote from E.J. Smith, who's the captain of the Titanic, where he's basically saying that he'd never ever been involved in any kind of an accident. He'd so far in his life been able to guarantee that nothing bad had ever happened, and therefore he expected always a good outcome. Well, this is the deterministic mindset. This is the predictive mindset at work. And of course, everything ultimately in life is uncertain. Despite all of those abilities I spoke about, despite our cognitive faculties and everything else, to try and create an environment that is predictable, where we can predict outcomes. Well, certainly a ship on the North Atlantic dodging icebergs is an example of where maybe they got a little bit too cocky. But in any event, that just illustrates the human condition. So we've spoken about how the brain is a predictive engine and how we look to gain control over the environment. But all of this is just a symptom of your default way of operating. And that's called the deterministic mindset, which is the opposite effectively of a probabilistic mindset. It is just the way we are made. And you need to understand that it is your number one weakness when it comes to trading. You can get around it, you can dominate it, but it is the challenge. All right. Okay, so then what is the correct approach? Well, we're going to talk now about this probabilistic mindset, obviously, coming to that. But effectively, the word is wrong. Okay, I just want to put it out there. Probabilistic is still misleading. The fact of the matter is there isn't really a word for what I'm trying to describe here. And the reason I say that is because when we talk about probabilities, we're talking about the probability of something happening, which is the odds of something happening or not happening. I'm sure you'll agree with me. So when I say that, well, the probability of the next trade losing is like 90%, should we take the trade? And you're going to say, well, no way. Why would I take a trade where there's a 90% probability of it losing? Um, that is the problem with this word, is it focuses purely on a binary outcome. It's either a 0 or a 1. Even that's not correct. It's either a +1 or a -1, if you like, a positive outcome or a negative outcome. So that's how the word or the concept of probability works. But when it comes to what we need to do as traders, we need to think even deeper than that. What the word probabilistic, in fact, reflects is, again, the human brain's obsession with prediction of an outcome without fully appreciating, or in fact, even completely ignoring the fact that different outcomes have different consequences, both positive and negative. So when I say, well, there's a 90% chance of the next trade losing, the natural instinct for most people, except for you guys, of course, because you've been on my training for a long time, the natural instinct for most people would be to say, no way, I'm not going to take that trade. Until I say to them, well, actually, what you didn't ask me is how much do I lose if it loses? But on the 10%, the 1 in 10 chance probability of me actually winning that trade, how much do I win? That would be the right question, but most people wouldn't even think to ask that question, because when it comes to this, again, it's the wrong word, but this probabilistic mindset, a correct or a complete probabilistic mindset, a complete trader's mindset, would take all of that into account. So you would then have a trader like Nassim Taleb, who used to lose 19 out of 20 of his trades, but the 1 out of 20 that would win, and he had no idea when it was coming, obviously, because then he would just avoid all the losers. And it wasn't necessarily 1 out of every 20 trades. He might have to do 30, 40, 50 trades before he got a winner. And then he might have 2 or 3 in a row. It's not regular, okay, which makes it even worse. But his winners were on average 50 times as big, times the size of his losers, which means that if you had traded 20 trades and lost 19, and let's just pick a number, let's say he lost $1 on each of those 19, he would have lost $19, but his winner would have made him 50. Now, if I was to ask you in advance of describing that, or asking the average man or woman on the street, who's the better trader, the one who wins 19 out of 20 or the one who loses 19 out of 20 trades? The initial, immediate, instinctive, natural response would be clearly the person who wins 19 out of 20 trades is the better trader. Well, I would say to you, that's completely wrong. You need to know more in order to be able to answer the question as to who is the better trader. And in the case of Nassim Taleb, clearly he was the better trader. Why? Because he ended up with all the money. Trading is not about being right. It's about making money. In fact, an old trading friend of mine used to say, what do you want? Do you want to be right, or do you want to be rich? And that is the question that you need to resolve for yourself in this process of developing a robust trader's mindset or probabilistic mindset. All right, so this brings us to the issue that we have to deal with in our trading. So we often use gambling examples to illustrate this principle. You guys have seen me use spreadsheets like this, where it's the probabilistic P&L, effectively, where we can look at different types of strategies, where things pan out differently. Typical one being one where you have a 60% win rate, which is a 60-40 success ratio, which is equal to 1.5 to 1, with a reward to risk ratio of 1 to 1, giving us an expectancy of 1.5 to 1, which is basically means that for every dollar you lose, you make $1.50. And that all works out over 100 trades to give you gross winnings and gross losses with a net of 20. So you've seen that before. But what none of this fully reflects is that we're not dealing with a closed environment like we would be at a casino. I mean, if we were to say, this is a dice rolling game where, we're going to win if it's 60-40, well, that's not entirely correct. Let's say 66% win rate. If we will win if a 3, 4, 5, or 6 comes up, and we will lose if a 1 or a 2 comes up. That's not quite that. Obviously, that would be a 2-to-1 success ratio. But nevertheless, it would be the sort of thing that if you're winning, let's say, the same amount on your winners as you're losing on your losers, sure, you can just roll that dice all day long, and why not? You'll have all the money at the end of the day. The problem with trading is that this is not a closed environment. It's not like a casino-based environment. The thing with trading brings us back to what Mark Douglas says: anything can happen. Because you see, in a dice rolling game, you can't have a blue come up, never mind an 8 or anything else like that. Literally, you've got 1, 2, 3, 4, 5, 6. That's it. Those are the only possible outcomes. Whereas in the markets, anything can happen. It's possible that some massive financial disaster could strike at any time, which would cause all the banks to fail. I mean, that would be the extreme example, and in which case, if you don't have all of your money invested in gold buried under your bed, and Bitcoin is not going to help you either, because all the electronic systems will go as well, you've lost everything. Okay, everything in your trading account, in your bank account, the whole two. Okay, so unless you're holding physical assets that you can barter with or trade, you're stuffed. So that would be obviously the extreme. But it just goes to show that, the sort of things that can happen in trading, and we've seen them, like a gap of 1,000 pips. We saw that in 2015 with the Euro Swiss franc, where the market had an average true range of something ridiculous like 8 pips or whatever the day before. And then in January, I think it was the 8th, somewhere around there, 2015, we had a gap of over 600 pips, where people and companies, hedge funds, brokers were wiped out, absolutely wiped out, because something happened that nobody had ever expected to happen. Something had happened that had never happened before. Whereas in a dice rolling game, you can only get 1, 2, 3, 4, 5, or 6, as long as you stay in the game. Obviously, the dice might get lost or something like that. But as far as the risk you're taking in trading, it's different. And therefore, you need to develop your probabilistic mindset to a greater extent than if we were just playing a dice rolling game. And this is where convexity comes in. And this statement at the bottom here, limit downside, maximize upside, is effectively, it embodies the principle of convexity. Okay, we've spoken about that before, and you've seen me talk about it many times, but let me just go to the diagram of the turkey problem. Okay, but this graph on the right represents convexity, where the amount of pain that you can suffer is limited to a maximum, and quite a small maximum amount. Yeah. Whereas the amount that you stand to gain is potentially unlimited. And that's why this curve is shaped more like a smile, or maybe a smoke, for those of us who understand convexity. Whereas what most people do is they adopt the opposite approach. If you've got a highly predictive model, and employment comes to mind, where you know what your salary is going to be at the end of every month, and you believe that it's guaranteed, but unfortunately it's not, because actually anything can happen, even in employment terms. Okay, your company might fail, your industry or your technology or your job might become redundant. You don't know, you might never be able to get another one again. Of course, that brings us back to education, which helps us to guarantee outcomes. But for anything with highly predictive outcomes, your upside is generally limited, but your potential downside is much larger and potentially even unlimited. Although that is normally hidden. The risk of highly predictive models, especially in the markets is normally not visible until it happens. And that example of Euro Swiss franc, and please be my guest, go and see what happened on your charts and look at it on a lower time frame if you can, like an hour chart. In early January 2015, in fact, you could look at just about any currency pair in that period and see that enormous volatility that took place. So it just proves the point, though, that the kind of things that can happen are hidden. Did anyone ever see the coronavirus on the horizon and what its impact was going to be on the markets? No, of course not. Going back to the election of Trump, it was a big surprise. It was a possibility, so it wasn't completely hidden. But most of the most important things that will impact your life, and certainly your trading life, are completely invisible until they happen. And your approach to trading either takes that into account or it doesn't. So why is this so important for us in terms of developing this probabilistic mindset? Well, because in order to have a convex approach to the market, you need to do the exact opposite of trying to predict. You need to take an approach, and by the way, this can be used, by the way, in your investments, your general investments as well. Instead of taking a traditional approach to investing and diversification, there's a better way of doing it. But when it comes to your trading, using this barbell type approach, you need to adopt a convex approach to the market, which means you focus on limiting downside and maximizing upside. And that's also embodied in one of the most famous and long-lived sayings in trading. You need to cut your winners. I wish that would definitely not work. Cut your losers and let your winners run. So if you do that, what you're doing is you limiting downside and maximizing upside. And most people will say, well, yeah, absolutely. I mean, that makes sense. Of course, I want to cut my losers and let my winners run. I want to limit downside, maximize upside. But in reality, what people do in practice is in fact the opposite, because of the deterministic nature of our brains and the way they work. So if you are focusing on avoiding losers, then you will take action accordingly. And most people say, well, by trying to avoid losers, that's the same thing as limiting downside, isn't it? Well, actually, no, not at all. By trying to avoid losers, you're trying to guarantee the next trade being a winner. That is the exact opposite of convexity. That is concavity. That's where you have a limited upside and potentially unlimited downside. What you need to do, instead of taking a predictive approach now, is you need to take a positional approach to your trading. And that is an essential element of when it comes to the practical application of this probabilistic mindset. That means that when you do your technical analysis, you're not doing it to try and predict what's going to happen next in the market. All you're trying to do is determine whether market conditions are appropriate for any of your strategies at that point in time. And just as importantly, if not more so, not appropriate for any one of your strategies. So that's why our technical analysis that I've taught you guys is all about determining where we are at in the market's life cycle, not so that we can guarantee or predict what's going to happen next. Not at all. Not at all. It's simply about being able to position yourself appropriately. So, for instance, if you are trading a trend continuation strategy, you need to be able to determine probabilistically that we are in a trend and not in a consolidating or ranging market. Secondly, because it's a continuation strategy, you need to determine whether you are in an impulse or corrective wave in that trend. Because continuation strategies require you to position yourself whilst the corrective wave is still ongoing, but you are positioning yourself for the continuation of the trend. Now, if you can't answer those questions, then obviously you've got a problem, but that's what the skill set is all about. That's why we do technical analysis. But the point here, from a practical perspective, is the purpose behind that technical analysis. You're not doing it to predict the market. You're doing it so that you can position yourself appropriately. Now, if we look at our impulse strategies, for instance, I'd say a long-term success rate of an impulse strategy is probably around, well, close to 40%, but not quite there. It's in the 30s. So let's say, let's go extreme. Let's say it's about 33%. That means on average, you're going to lose 2 out of 3 of your trades with an impulse strategy, which again, most people would not be able to do. Now, all you need to do is answer the question, am I in a trend on this time frame, probabilistically, and does it look like the retracement wave is over on the selection time frame? Those are the 2 questions that we ask ourselves. And we ask those questions not to predict that there's going to be another impulse wave or that trade is going to win. It's simply because those are the appropriate conditions for an impulse strategy. And obviously, they would drop down to the lower time frame for the final selection criteria. But the purpose, again, here is probabilistic in nature. It's not deterministic. So hopefully, you can see that that's where the practical application of our probabilistic mindset comes in. Now, the other practical side of this, while we've still got some time here, let me just check. Remember, if you've got any questions, folks, pop it into the chat box. Otherwise, if you're watching the recording, please feel free to ask questions in the comments below. All right, so what we are effectively doing when we are exercising this probabilistic mindset, we're looking to position ourselves, understanding that the next trade may well lose. We are using our 3 pillars. You guys should know that. We've got an edge. The nature of that edge is convex, which means it limits downside, maximizes upside. And then finally, we understand that we are using the law of large numbers to generate a long-term positive expectancy. And we make sure that our drawdowns never place us at risk of disaster. So what that allows us to do again now practically is to take a trade where our expectation of the outcome of the next trade is at most neutral. What I'm saying is that for most people who, when they start out trading, is they trade strategies where you've got a higher probability of the trade winning than losing, which is natural. We understand that. In fact, anything else, as I've described to you, wouldn't make sense to an amateur or a new aspiring trader. But because of that, their expectation of the outcome of that trade is positive. They will only take the trade if they believe that it will win. That mindset is the epitome of a deterministic mindset and the opposite of a probabilistic mindset. Again, Mark Douglas describes this very well in his book, Trading in the Zone. In fact, if you don't have a copy, please drop into the comments that you don't have a copy. We'll send you an electronic version. It's absolutely essential that you read that. And he describes very well the power of expectations over our lives. Now, the impact of unmet expectations, which basically is disappointment, is cumulative. So even if you're marginally profitable, and you can't expect to be very profitable with predictive strategies, and that's a mathematical, I could prove it mathematically, let me put it that way. The problem with that is that sooner or later, the trader will self-sabotage. And sooner or later, they're going to find themselves with a string of losers that they are not equipped to deal with. So if you are only taking trades that you believe are going to win, and you refuse to take a trade if you doubt that it will win, it's not going to stop the trades from losing, because you can't predict the market anyway, unfortunately, but factually. So sooner or later, you're going to find yourself in a scenario where you've not just got 1 or 2 or 3 or even 4 losers, but 5, 6, maybe 7 losers in a row. And you are not equipped to deal with that. And that's when all these other things that people talk about start coming in, getting revenge on the market, starting to remove your stops, starting to add to losing positions so that you can get out with a break even sooner, etc., etc. I mean, there's a whole string of options open to you that you will inevitably start doing. You will fall into that trap sooner or later if you haven't developed a probabilistic mindset. Whereas, practically speaking, a trader who takes trades using with a strategy that's convex, they understand that they're going to probably lose the next trade. If it does lose, well, their expectations are actually met. So the level of disappointment and the ability to cope with a string of losers, which they expected in the first place, is vastly higher. And therefore, their ability to stay consistent is vastly higher. The ability to continue taking the next trade, to not break the strategy's rules, to not take revenge on the market, their ability to do all of those things, and ultimately to remain relatively unemotional about their trades in the short term is vastly greater. And that is the power of not only developing a probabilistic mindset, but because of that, recognizing the power of convexity in your trading, for which you need a probabilistic mindset in order to apply it. Because the outcome of a probabilistic mindset, the practical outcome of it, is one thing and one thing only, and that is the ability to remain consistent. All right, and that's it. That's the story. So we're going to go into this in some more detail in our masterclass next month. If you've got any questions, please do pop them into the comments below. Be happy to answer that. But there's obviously a lot to this, but nevertheless, I think you can see that there is a fork in the road that you come to sooner or later, and depending on which route you take or which leg of that fork you take will determine whether or not you succeed as a trader. All right, folks. So that's it from me for today. I hope that's useful. Please do put it to use. And yeah, almost at the end of the week. If I don't chat to you again, then remember, Monday morning is our market review. So have a great weekend, and I'll chat to you then. Bye for now.